Welcome to the InterMarket Analysis video update. Every week I prepare this video where we look outside of the S&P 500 and even outside of the stock market to see if we can get some clues about what's happening inside the S&P 500 based on what's happening across the different markets. I also go through a valuation look at the S&P 500 both on a historical basis and looking forward. Then I go through a pretty extensive list of charts where I compare growth versus value. We want growth to be doing really well when the market's going up. If we see value starting to outperform, that's when we get concerned about things. So we want to look at that in many different ways to see how things are going. This is being prepared for Monday, January 6th. First of all, let's look at valuation. Now, this chart is looking back at earnings reports that have already come out and then comparing them to the price of the S&P 500. This creates a PE ratio or a price to earnings ratio. And what we have are a series of dashed lines here. When we get a PE ratio of 10 or below, the market is considered to be inexpensive. When we get up to the blue area, the market is fairly priced. That's kind of the Goldilocks area. And then when we get up to the red dashed line and go above it, the market is considered to be expensive. And that's what we've been seeing for quite a while now. Now, over the last couple of weeks, the market didn't have a Santa Claus rally. Things are a little bit shaky right now. Volume has been below average as we've worked our way through the holidays. There are some folks that are predicting doom and gloom. Yeah, we're negative in the short and intermediate term when you look at it on the daily charts. But right now, it's looking more like a pullback. But we'll keep watching it. This could morph into something more severe. That's why I do the videos every day. And if you want an update on those, please feel free to check those out. I post them on YouTube and Rumble in addition to this video. So we just keep an eye on this. This has been going on for a long time now. I personally don't use this chart to make decisions. It's more just to say, yeah, the market's expensive on a historical basis. This also looks at that same basic idea with historical earnings reports and goes back to 1980, and then what different events happened along the way and what the valuations were at that time. And you can see we've been above this red dashed line, except for a few exceptions when the market's really been going down for years now. Then Robert Shiller came up with a different approach with this. Instead of using one earnings report at a time, he spreads it out over 10 years to get more of an average. And that's called the Shiller PE ratio. This is also quite expensive right now, 37.74. We look at this over the historical period going back into the 1800s, and we're between 16 and 17 now. And so we're over double on a historical basis of looking expensive with the market. But the market doesn't do things that way. They look forward. And this is a chart that is put together by Edward Yardeni at yardeni.com. And we have a number of different indexes that we look at. The purple area on top are called the Mega Cap 8. These are the big ones, the Google, the Nvidias, the really big stocks that really drive the market. And when we look at their PE ratio looking forward based on projections and forecasts, we're coming in at 30.2 right now as of Friday's close. And that's even down from where it was before, but still we're way above that 20 level. We still stick to the 10, 15, 20 level, even when looking forward. But folks are okay with that. It's like, okay, well, their earnings look good. They may be a little expensive right now, but we can even go up further than where we're at right now at the same time. Then the one that I focus on the most is the red line. That's the forward-looking PE ratio for the S&P 500. Even with the difficult times that we've had over the last couple of weeks, we're still coming in over 20 at 21.7 looking forward. More fairly priced are the mid caps and small caps. Now, small caps were supposed to already be at the moon by now, or at least on the way. That hasn't really happened. They've been chopping around sideways. And the mid caps, they're one of the weakest indexes that we're looking at right now. They're coming in at 15.6 for the small caps and 15.9 for the mid caps. They're down here, but they've been coming down because they've been under pressure. It's not that their earnings are necessarily doing better. It's that the indexes have actually been coming down. So if you look at this on a valuation basis, you might be more interested in the smaller mid caps, but are there the earnings behind these companies? Now, a lot of the mega caps, they started out as small caps and then grew to mid caps, large caps, and now they're mega caps. But a lot of these small companies, they don't grow that big and they may not be around for very long. That's why you really have to look behind the company and see what are their earnings doing? Are they growing? Are they showing profits? What about interest rates going up? Is that going to pressure this company? Do they have a lot of debt? Those are the different things that somebody who does fundamental analysis may look at, just one of a multitude of things. I tend to focus more on technical analysis where I look at charts. Okay, then long-term earnings and the S&P 500, they're perfect together. This is a very long-term chart here showing if earnings go up, the S&P goes up. If earnings go down, the S&P goes down. Very simple. That's ultimately what drives stock prices. Now, they can get out of line with that. They can get above or below the earnings going forward. They don't usually get below it too much, like we had the COVID crash and all of that. But usually, when we look out, this is what folks tend to focus on. Are they making at least the opportunity for earnings? And then that goes hand in hand with the price. Okay, another thing, the PE ratio of the top 10. Now you've got the Magnificent Eight, the Significant Seven, the Illustrious 11, whatever you want to call them, or whatever group you want to use. This is just showing that same basic thing. This is comparing the top 10 stocks and then the rest of the stocks that make up the S&P 500. And we're coming in, this is a little bit lower. This chart's a few days old. We're at 29.8 with the top 10, where the average is 20.6. So we're way above that. The remaining stocks are at 18.2. So they're under that 20 level, but they're still well above their average of 15.7, where the S&P taken altogether is at 21.5, where the average is 16.6. Now, some people really rely heavily on this. I like to know about this, but like I said earlier, I don't base my decisions on this. We look at charts and we see what the trend is actually doing. Okay, then we look at growth versus value. First of all, I look at just a peer growth index, which is in an uptrend. It's been coming down, excuse me, but it's starting to come back above its 50-day moving average. That could be positive. And it's also in this longer term uptrend, which is positive when you look at it by itself. Then we look at value. Been under a little bit of pressure lately. Still in an uptrend. The blue line's above the red line, but we've really been coming down and then we've been chopping sideways lately. Value hasn't been performing as well as growth when we just look at the growth and then we look at this value chart. Where we get additional insight is by doing ratios between the two. This shows that growth is outperforming value, and then I do an inverse of that, showing how value is underperforming growth. Now, if the rest of the charts after this are showing the same thing, then we're still pretty comfortable that growth is outperforming value. And at least for right now, and the way it has been through 2024 and going into 2025, that's a positive thing for the market. We look at another ratio longer term. When this is going up, that means growth is outperforming value. It's taken a hit here. It's come back down to its 50-day moving average, but now, anyway, it's starting to bounce back up. Here's an inverse, shorter term time frame. This is going down. That means value is underperforming growth and still confirms that growth is outperforming value. Then we look at a couple of ETFs, longer term. This is really going up, meaning that growth is outperforming. There's an inverse showing how value is underperforming. Then another index, shorter term here, growth is really outperforming value. And then we look at a growth ETF and do a ratio with a value ETF, coming down a little bit here, but coming off of setting a new high with this particular ratio. Then here's an inverse of that same thing, how value is underperforming growth, even though it's been bouncing back up lately. So we're seeing some confirmation here. Then we break it down a little bit more and we look at the mid caps. Usually I look at the small caps first, but I have the chart in the wrong order here. You see the index, it's really been coming down and we've been just chopping sideways. We're not really moving, but if you look under the surface, growth is outperforming value on an end of day chart here. And that is potentially positive under the surface. We just haven't seen it come through in price, at least yet. Seeing the same thing with the small caps. Really coming down, going sideways. But the growth to value ratio, it took a bit of a hit as we've been under pressure. It really bounced up on Friday, but it is still in an uptrend. This could be some under the surface strength that could help things go up. Now, this has been building for a while now, and it really hasn't led to much. So we don't know, are we going to lose this or is it going to be delayed for a while? All right, then we look at S&P growth to value. In an uptrend, pulling back recently, but then bouncing up on Friday. This is another thing. We want to see this continue to go up. That would help the S&P to go up. Are we going to be able to hold on to this? Then we keep an eye on inflation. First, I look at a monthly chart of the commodities index, the CRB index, and we're going pretty much sideways with a little bit of a drift higher with inflation. And then we do a ratio between inflationary areas of the CRB index and deflationary areas of the CRB index. And this continues to go down, even though it's kind of flattening out right now. This is a monthly chart, so this is quite long term. And then we look at a daily chart of the CRB index, which is starting to show some strength again. The market's getting a little bit concerned about this. We're going back into an uptrend here with the CRB index. We'll just keep an eye on this. We haven't really broken out above the previous high. We haven't really broken out of this range that we've been in. We're just at the top end of it right now. And another thing that can help us with inflation is the Baltic Dry Index. What does it cost to ship products from point A to point B, specifically in the Baltics, the Baltic Sea? It's coming down, although it did tick up a little bit here, but it's well below the moving averages. So this is suggesting there's not a lot of inflation concerns right now. Then what about the market? We have this chart called the inflation expectations, where we're going up here. Came down a little bit on Friday. We'll keep an eye on this, and if this really continues to go up, then we'll keep an eye on it even with more intensity. But even though this has been going up, the market's been going up too. So this, just because this chart is going up, is not necessarily negative for the stock market. And just to keep an eye on some other markets, we've been coming down with aluminum, even though we're still in an uptrend. Corn is going up, even though it's still in a downtrend. Kind of interesting there. And wheat is still in a downtrend. And then we keep an eye on fertilizer. This is a little bit longer look because we're starting to go up here. We want to keep an eye on this. And this goes over the last year. And if we start to come up and surpass this previous high set, well, it's a ways off now. It'll be in March of 2025. That's when the previous high was in 2024. We'll be keeping an eye on this just to see if that turns into something. Oil has been going up again. There's some unsettled things going on in the Middle East. There's a situation between Ukraine and Russia and all of that. We've been kind of camped out around the 70 level, but we did go up this past week. We're up into the high 73s now. Want to keep an eye on that one. And then we look at a ratio between gold and oil. Well, gold has been under pressure, even though it's been doing quite well in the bigger picture. And then with oil going up recently, this ratio has actually been going down as gold's been underperforming. Then we look at oil to the 10-year yield. And you can see over a period of time, they tend to go more hand in hand with each other and get not too far apart. Well, we're seeing a pretty wide separation. Now, yes, they are on different scales. So what we look at is what direction is oil going? Well, lately it's been going up here. And then we also look at the 10-year yield. But when we look down below, we're more neutral with this relationship right now. It's not really going in the same direction or in opposite directions. Gas is in a downtrend. And diesel spiked up a little bit here, but overall it's still in a downtrend. Natural gas really starting to go back up, and we're starting to see a golden cross here. And that's just suggesting a new uptrend is being established there. I want to keep an eye on that one. Heating oil has been bouncing up, but still in a downtrend. Copper, which is more of a barometer of the economy, one of the things that I look at, it's in a downtrend right now. It's still on a loose uptrend on the weekly chart, but here it's more in a downtrend, and it's been under pressure lately because there may be some inflationary worries and economic slowdown that might be anticipated by the market. Then we look at a copper to gold ratio. When this is going down, that means copper's underperforming. That's when it's been happening. And then I have a longer term chart going back to 1980, where the black line, that's the copper to gold ratio, which is going down. And then we also plot the 10-year yield in red and the 2-year yield in green. And you can see they tend to not get far apart from each other. Now they are far apart, even though they're on different scales. And they tend to move in the same general direction. Well, interest rates have been going back up as this ratio is going down. And so we're wondering, are we entering into a new type of economic environment? And I've been saying that now for the last couple of years as I've seen this real divergence between the interest rates and the copper to gold ratio. We're just kind of waiting to see how that plays out. And gold is in an uptrend, but it's below its 50-day moving average. And I look at the gold ETF. I look at the futures contract, but this is the one that I use for this particular video. I also look at the silver ETF. This is kind of interesting, coming down to its 200-day moving average, even though it's still in an uptrend. Is it going to fall further down below, or is it going to bounce up off of this at some point and actually resume going up? And we look at the closing price for gold on top and the closing price for silver in the middle area, and we look at the correlation between the two. It had really been dropping off. As silver was going down, gold was holding up a bit better. Now it's ticking back up, but we're getting closer to more of this neutral territory with this. And that's kind of unusual. We typically see a pretty high correlation, a high reading down here at the bottom between the top chart and the middle chart. And they're getting a little out of line with each other right now. We look at a gold to silver ratio on top, and then we compare it with the US dollar index. There's a pretty high correlation. Now, on the top, when this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming. And then we compare it to the US dollar index. So we have precious metals and currencies interacting with each other. And there's a pretty high correlation right now between the ratio that we see on top and the dollar itself. The dollar's been pretty strong lately. In fact, here is the dollar. We're in an uptrend. We got up into the 109 range. We since have dropped down into the high 108 range. And that's usually more negative for stocks because the conversion rates, it's not as friendly when the dollar's stronger. It doesn't look like you have as much money from an accounting perspective. And also the import-export relationships get out of line a little bit. So unofficially, the stock market likes a weaker dollar. Officially, the US government has a strong dollar policy. Then we look at the euro, which has really been coming down when compared to the US dollar index. And we'll also keep an eye on the Japanese yen, which has been coming down. The euro's been coming down as the dollar's been going up. And I break them out here. We're in a downtrend with the euro to the dollar. And as I've been saying this in different videos, this might be a good time to take a trip to Europe. I mean, they're almost at par with each other, where usually the exchange rate isn't as favorable when you want to take dollars and change them into euros. They're getting pretty close to each other right now. This is a chart put out by Bloomberg, and I don't like these kinds of charts, and I'll explain why. Euro hits weakest level versus the dollar in over 2 years. Okay, fine. That's a true statement. But why I don't like these kinds of charts is we're going down right here. When we were at the same level before, what was the euro doing? It was going up against the dollar. The whole context is different. Folks love to say this, the highest level in 6 months, the highest level in 45 years, the highest level since yesterday, whatever they want to say, but it doesn't tell you the context. This is a headline that's meant to grab your attention, not necessarily clue you in as to what's actually happening. Look at the context of what's happening in the chart itself. Okay, the yen is in a downtrend compared to the dollar. British pound also in a downtrend. It's not quite down to par yet where they're even with each other, but yeah, it might be more advantageous to consider a trip to England one of these days if you want to get a good conversion rate for your currency. I do show this in the daily video. This compares the weighted version of the S&P, which is the bar chart, and the equal weighted version of the S&P. Same stocks, just calculated in a different way, where we've been coming back up a little bit, but the red line is far away from the bar chart. Now, yes, they're on different scales, but when they're moving more hand in hand with each other, that means the rest of the S&P is participating. When this tends to hold up better that means the bigger stocks are holding up better. The mega caps, those are the ones that really control the index. And this is another way of looking at that same thing, where we do an equal weight ratio with the S&P when this is going down, which it bounced up on Friday, but it has been going down lately. That just means the equal weight index is underperforming the S&P 500. And I mean, the market can still go up, but when it's most healthy is when we see this ratio going up and the S&P going up as well. But there are times when the S&P's just been skyrocketing, mainly controlled by a few stocks, while this ratio has been going down. We look at stocks versus commodities. Even though we've been pulling back, commodities are seeing some strength right now. Stocks have been under weakness. We're still in an uptrend, meaning stocks are outperforming, but we have been pulling back. But we haven't dropped below the 200-day moving average with this ratio. We're also seeing how commodities are underperforming in the longer term compared to stocks, even though commodities are outperforming on a shorter term basis. We're going to be watching this to see, are we going to cross above the red 200-day moving average? Are we going to eventually see a golden cross here? That could mean the overall environment is changing. And we look at the NASDAQ 100, which is actually holding up fairly well, and the S&P 500, which is not too far from its all-time highs. But we do a ratio between the two. And when this is going up, that means the NASDAQ 100, the bigger stocks, are outperforming. Now, that also helps the S&P because the stocks in the NASDAQ 100, they're also in the S&P 500. So you get some overlap there. We look at the S&P 100, which are the biggest stocks in the S&P 500. The big stocks continue to outperform, even though they've been pulling back, coming under the 50-day moving average with this ratio. The NASDAQ, which is also holding up fairly well, we're right at support. We came down to the 50-day moving averages on the daily chart of the NASDAQ and the NASDAQ 100, and we're waiting to see, is that support level going to hold? We broke through the 50-day moving average on the S&P 500, and that's been a little bit of a concern. That's why I've switched over to negative in the intermediate term. Well, if the NASDAQ can continue to outperform, that may bring the S&P 500 up with it if we continue to go up. The NASDAQ 100 is underperforming the NASDAQ. The NASDAQ, which is a much broader index, it's really been outperforming going back to last spring. But they're both doing good. But the NASDAQ is actually doing better than the NASDAQ 100 when we look at this ratio. Mega caps, though, are really outperforming the equal weight version of the S&P. And even though it's been pulling back, this is still looking pretty solid. Small caps are underperforming. They're supposed to be really up right now. If they're going to take off, it hasn't really happened yet. This is another look at the small cap to S&P 500 ratio. That's the red line here, where it's just been going down, down, down. The blue line is the S&P itself, which is, for the most part, been going up, up, up. The robotics and AI ETF, showing a little bit of a bounce in an uptrend, coming up to the high end of the rainbow, and looking a little better, but still coming up to the underside of the rainbow when we compare it to the tech sector. This is the area that everybody's talking about, but yet look at how it's been underperforming the tech sector here for, well, going back to into 2003. I'm sorry, 23. Blah, blah, blah. Okay, the mega caps. This is all by itself, coming down, but still above its 50-day moving average. The Dow Jones Composite Average, which is the Dow, the transports, and utilities put together, seeing some weakness here under its 50-day moving average, but still in a longer-term uptrend. And we look at the Wilshire 5000. This is a daily chart. This is one of the 50-period moving averages that I'm watching right now. On the S&P, for the last 4 trading sessions, actually maybe 5 sessions, the 50-day moving average, we sliced down below it and have not been able to get back above it. We're right a little bit below the 50-day moving average with the Wilshire. Now, the S&P 500 is 503 stocks. This is a broader market measure. If this could get back above the moving average, that would help the overall market. Of course, if it breaks down, that'll be more negative. Another ETF is called the Total US Stock ETF, and it's coming back up to its 50-day moving average as well. So, and we're still in a longer-term uptrend. We're not necessarily falling apart here. Low volatility have been in a really solid uptrend. Now, these are more defensive stocks. This is what folks get into when they think the market's going down. When you look at this all by itself, going back to the beginning of 2024, this has been in a really solid uptrend, which is like, wait a minute. we've been going up with the S&P. How come this is going up too? Where we get some insight is when we do a ratio between the low volatility ETF and the SPY, which is the ETF for the S&P 500. And it's really been underperforming here. There was a period of time where it started to bounce back up here and enough to generate a golden cross, but it really didn't last very long. And we're really going down with this ratio. So it's been underperforming the S&P itself. Seeing a little bit of an improvement here with the advanced decline line across multiple indexes, but we're turning up after Friday's session, but we're still below the moving averages with all these indexes. And that's a little bit of a concern. We want price to go up enough to get back above these moving averages. And you can see we've been under this for quite a while where the moving average is starting to roll over a little bit. We'll keep an eye on this and see if it ends up turning out to be more negative. But for right now, we're not too far away from the moving average. And if we see some good buying coming in the upcoming week, we could get back above these moving averages. If we don't, then next week when I do this video, it may even look more negative. We use a thing called traditional Dow theory, which in its purest sense, it just uses the Dow and the transports. And it says, okay, when one makes a high, the other one needs to make a high to confirm each other. They both have been coming down, and the transports have been a bit weaker here. Utilities were really strong, but then they came under some real weakness lately. And I just look at this. I have some variations of this that I'll show in just a moment. The transports were looking pretty good. Now they've been falling back, and we're more into this range that we've been in. We look at the Dow to transports ratio. When this is going up, that means the Dow's outperforming. Coming down a little bit here, but still, even though the Dow's been under pressure, the transports have been under even more pressure, and that's why this ratio has been going up. Then we look at another ratio. We take the Dow transports and compare them to the S&P 500. Really going down here. It bounced back up recently, but not enough to change the overall trend. Then we look at the correlation between the S&P on top and the transports, the Dow transports. We see that there's a pretty high correlation between the two, meaning they're going in the same direction at the same time. And we take a different approach to Dow theory. Instead of using the Dow, we use the S&P. Okay, set an all-time high, but been bouncing around since then. Instead of using the transports, we use the NASDAQ. That's more of a real representation of the US economy now. Holding up okay, but still off of its high. Breaking that out a little further. Instead of using the S&P weighted version of the index, let's use the equal weight version of the index. And instead of using the whole NASDAQ, let's use an equal weight version of the QQQs, which is the ETF for the NASDAQ 100. Also under some weakness here. So they're more matching up with each other. We're not seeing any real divergences right now. The FANG index, these are the real big companies. This is another look at the mega caps like Facebook, Apple, Amazon, Netflix, Google. Even though it's been coming down, it's not even down to its 50-day moving average yet. So this is far from falling apart. Pulling back, yes. If we see more weakness, yeah, we'll get more concerned. But right now, it's been holding up. Then here's a longer term chart where I have the short term trend line up here. We tried to get above this and we couldn't stay there. We ended up falling back down. So we're right underneath, or we're about in the midpoint, I guess, with the short term trend and this longer term trend line here. If we continue to fall, we'll wonder if this area would be able to provide support. ARK, a very popular ETF, coming back recently. It was up 5%. My goodness, that was a good day on Friday because they own so much Nvidia and I'm sorry, Tesla. And Tesla just shot up big time in Friday's session. And so ARK went up as well. It had been coming back down to its 50-day moving average. It's still in a longer term uptrend. Then we look at the all world ETF, and that takes out US stocks. Not looking really strong right now. We could see a death cross with this particular ETF. And just to confirm that US stocks are doing better, this one is almost in a downtrend. When we compare it to US stocks are really outperforming right now. And we look at the small caps and compare them to the tech sector on a ratio basis, just chopping around. But for the most part, the small caps have been underperforming. Then a longer term chart here. This is monthly. This is another ratio between US stocks and world stocks. We're still showing that US stocks on a longer term basis are outperforming, and the PPO, which is a momentum oscillator, is also still going up. Keep an eye on bonds. This has been pressuring the market because when we go down with the bonds based on price, that means we're going up based on yield. Okay, then we look at the price of bonds here with a total bond ETF. This is coming down to its 200-day moving average. It'd be kind of interesting if we could hold this support area. We did earlier in 2024. Can we hold this again? Start to go back up? Because if this is going up, that means interest rates are going down, and the stock market may see that as more positive, especially if we can get back below that 4.5 level for the 10-year yield. But world bonds are in a downtrend now. We saw a death cross not too long ago, and they continue to fall based on price. This also shows, even though stocks have been under pressure lately, bonds have been really underperforming for a long time now. We look at a monthly chart of a stock to bond ratio, and this is going up. That means stocks are outperforming. And then we look at a correlation, pretty much neutral right now between stocks and bonds. They're not going in the same direction. They're not really going in opposite directions right now. Then we keep an eye on high yield corporate bonds, which you might know these as junk bonds, coming back up and crossing back above its 50-day moving average. Corporate bonds, which are more conservative, coming down to their 200-day moving average. Are we going to? Here's another one. It's 200-day moving average. Can we bounce up off of that? That would really help things a lot. If we fall below it, that could turn things more negative. Here's the corporate bond index, also dealing with its 200-day moving average. So far, it hasn't significantly broken below that. If this can bounce up off of that, that could also bring interest rates down. 10-year yield. And then I have some Fibonacci retracement levels here. We're in between those. And we're getting up into a higher range with the 10-year yield, where we had been seeing declines over a 40-year period of time. And we might be shifting more to a different economic environment. The decline that we've seen over the last 40 years, that's actually the exception. Interest rates historically have been up in the higher range, and we'll have to see if we're going back to that kind of an environment. 30-year yield with Fib retracement levels right in between them, so we're not getting any insight here. We look at a 3 to 7-year bonds and compare it with the S&P 500. When this is going down, which is what it's doing, that means bonds are underperforming stocks. Junk bonds also coming back up here to their 50-day moving average. And we do a ratio between junk bonds and more conservative bonds. This is going up, meaning junk bonds are outperforming. And junk bonds tend to correlate a little bit better to the stock market. So that could be positive. And then what's happening here is interest rates were really coming down in anticipation last fall that the Fed was going to cut rates. And they did that. And then rates started to shoot up because the market's a little bit more concerned about inflation right now. Then we started to come back down. That really helped the S&P and stocks to go up. Now we've been going back up with interest rates, and that's what's been pressuring things lately. Internationally, we're still looking at US, UK rates being the highest. German rates are going back up, and we want to keep an eye on this 1% level with Japan in red. Last August, when interest rates really started to go up here, that's what caused the freak out on August 5th that took the market down, and everybody thought it was the end of the world. Lasted a couple of days, and then the market was able to right itself. If this red line keeps going up, that could produce another problem again. And it may start in Japan, but it could bleed over into Europe and then eventually into the US. So we want to keep an eye on this. All right. Looking at a ratio between the S&P 500 and short-term bonds, 1 to 3 years. Yeah, coming back down into the rainbow, but not falling apart. The lines are still going up. Then we look at the S&P 1500, which is a broad market measure with short-term bonds, coming down into the rainbow, but not seeing an awful lot of damage, at least yet. Another broad market measure, and then we go further out with 3 to 7-year bonds, coming back down into the rainbow, but could be improving. The tech sector to 3 to 7-year bonds near the high end of the rainbow. Riskier bonds, junk bonds versus conservative bonds still outperforming above the rainbow. Then we look at stocks by the S&P 500 and the 10-year yield. Now this has been coming down, even though the S&P is in an uptrend. As interest rates have been going up and the S&P has been under pressure, that's why we're seeing this ratio going down. And we look at the long-term price, or the price of the long-term bond, where it's been in a downtrend. We were starting to bounce back up here, but it's coming down. We look at another ratio of the long-term price of bonds with commodities, still in an uptrend, but possibly rolling over a little bit. We'll watch this. And this is long-term. This is a monthly chart. If we cross down below this, which is going to take a few months for this to work out, if it even goes that way, that could change the overall climate longer term. Then we look at the volatility of stocks and bonds. The MOVE index on top, that measures the volatility of bonds, and it's actually been coming down. Where the volatility of stocks, measured by the VIX, that's been pretty high now. And we're seeing a real disconnect. They're actually going in opposite directions right now. Where volatility for bonds has been going down, we're seeing volatility for stocks, for the most part, going back up. And that's why this correlation is getting such a low reading. Then we look at different sectors. First, I look at just the sector itself. Materials just been getting hammered. Going back to the beginning of December, even a little bit back into fall, into October, we've been seeing them coming down. They were still in an uptrend, but we've fallen below the 200-day moving average, and we're just falling, falling, falling. That could suggest some economic weakness. And when we compare it to the S&P on a ratio basis, materials are really underperforming. Communication, a growth area. This could be positive. Coming down to the 50-day moving average, we've held above that so far. This has been one of the stronger areas of the market, and it's also been outperforming the S&P. Even though the S&P has been doing well, communication has been doing even better. And we look at energy, really getting a hit, even though over the last couple of weeks it's been bouncing back up, but it's still below its 200-day moving average. And it's still underperforming when we compare it to the S&P, even though it's been bouncing back up lately. Then we look, and I have to move my little bar here. We look at the financials. We want financials to be strong. Back in 2007, going into 2008, the financials fell apart. Now they're looking pretty solid. They've been coming down. This is a little bit of a concern as we were dropping under the 50-day moving average, but we're kind of tracking, at least underneath. If we could get back above the 50-day moving average, that would be more positive. And then we look at a ratio where we've been pulling back with the financials, but it's still in an uptrend when compared to the S&P. Industrials, another area that could be influenced by the economy, coming down, drop below its 50-day moving average, but still above its 200-day moving average. And we're starting to get a death cross here with this ratio. We were actually showing the industrials outperforming throughout the summer months. Now they've really been pulling back. The tech sector, this is the real driving force behind the market, coming down to its 50-day moving average and starting to bounce back up. And now the S&P's been doing well and tech's been doing well, so this ratio has been going sideways, even though we are in a downtrend here. We were really shooting up into the summer months, and then we started to lag with tech, and it's been going sideways. If tech can start to outperform the S&P, that would bring the index up with it. And staples, this is another interesting thing, a defensive area of the market. If you look back in 2021, the staples were really going up. Think of toilet paper and toothpaste. And then these held up pretty well. You know, we had a really down year in 2022, but this held up fairly well. Well, we've been in an uptrend here, and I watch this from time to time, and I bring it up in the daily videos. I stopped doing that as staples have been under pressure. They dropped under their 50-day moving average, but they're coming down to their 200-day moving average. Now, this might help the market because staples can still go up with the S&P going up, but when it really starts to outperform, that's when we get concerned. This is a support level, and we'll see if that can hold. But when you compare it to the S&P, staples have been underperforming. Real estate coming down to its 200-day moving average. And this has probably been going down because interest rates have been going up. And really underperforming, seeing a recent death cross here, even though it bounced up a little bit in late 2024. But if interest rates go down, that may really help this particular sector as well. Utilities, very strong in 2024, but pulling back down under its 50-day moving average, even though it's been bouncing back up. And still in an uptrend when compared to the S&P, but showing a lot of weakness. And then I look at an S&P to utilities ratio. I haven't been showing it all this much. We're not seeing an awful lot of conviction, either up or down right now. We go up a little bit and then come down. We go down a little bit and then go up. So I dropped this from the daily video, but I look at it every day. If this really starts to show some conviction one way or the other, I'll be bringing it back into the daily videos. And healthcare, another defensive area. You have to have healthcare no matter what's going on in the economy. Seeing a recent death cross and not looking very strong now. And when we compare it to the S&P, it's really underperforming. Discretionary coming back down to its 50-day moving average. This is another growth area. We want this to do well. And this is actually, notice when we came down here in August and discretionary got taken out with everything else. Well, since that time, this has been the best performing sector of the market. Things like Tesla and Amazon are in this particular sector. And it's outperforming, even though it's been pulling back lately. So this is positive for the market when this is in an uptrend. Semiconductors, and I've been just hounding the daily videos with these charts because we have a couple of charts that are positive and support is holding. We have this chart here where we're in a downtrend and support has already been broken. We're trying to get back above the 50-day moving average. This is the SOX index. This is the semiconductor index here. This is actually looking more negative. If we could get back above the 200-day moving average, that would turn this more positive. And then we look at a ratio between the semiconductors and the tech sector, just chopping around. Now, it had a good day on Friday, but we've been here before. We need to see this really go back up to be more positive. When we were really going up with this ratio, that was early 2024. Then we topped out over the summer and we've been coming down. Now, that's not necessarily negative in and of itself because there were other stocks coming into the picture. The semiconductors and tech were lagging behind at that point. Other stocks were coming in to help drive the indexes higher. We're going to be watching this. It would be more positive if this ratio goes back up. And then this is more positive. This is the SMH Semiconductor ETF, still holding out above the 200-day moving average and able to get above the 50-day moving average on Friday. And we're coming up a little bit out of the rainbow, but you can see how we've been just chopping sideways a lot. Then we look at the energy sector and do a ratio with the tech sector. When this is going down, that means energy is underperforming. Energy bounced up this past week, so we're seeing this ratio coming up, but we're not even back to the 50-day moving average yet. We look at growth stocks and compare them with bonds. When this is going up, that means growth stocks are outperforming bond prices. We look at the tech sector compared to the 10-year yield coming down a little bit as interest rates are going up and the tech sector has been under some pressure, but still in a longer term uptrend. If this continues to fall, that's going to be more negative. If this can turn and go back up, that would be more positive. Here's an inverse of that same thing, showing how in the short term, the 10-year yield has actually been outperforming the tech sector. Discretionary to staples. I want look at this every day in the daily video. This is still looking pretty solid. And discretionary, the things that make life fun, staples, the things that you have to have. When staples are outperforming, that's when the market is more defensive. When discretionary is going up, the market is more in growth mode, and we're still looking pretty good there. Staples are underperforming discretionary on this inverse chart. Gold to the S&P kind of chopping more or less sideways right now. And gold has been under some pressure when compared to the dollar, so this ratio has been coming down. But when this is going up, that means gold is outperforming. The NYC composite, another stronger area. We were really in a solid uptrend above the 50-day moving average. We've fallen below the 50-day, but we're still above the 200, and we're still in an uptrend here. We need to get that 50-day moving average back. High leverage loans, another barometer of the economy. Looking pretty good. Hasn't even come down to its 50-day moving average, at least yet. All stocks, which are U.S. and international stocks, coming under the moving average because world stocks have been weaker and underperforming U.S. stocks. So it's not a surprise that we're seeing a little bit more weakness with this particular measurement here. Emerging markets coming down, dropping a little bit below their 200-day moving average. It would really help things out if this would go back up. The Nikkei in Japan coming back up above this red line is the high set way back in 1989. And we're coming back up and showing a bit of an improvement here. Micro caps also are still in an uptrend, even though they fell below their 50-day moving average. Bitcoin, it got up over 100,000 and everybody had a party and congratulated themselves, and we haven't been there since. We're at 97, so we're not all that far away. but it's been going back under its 50-day moving average as well. Then this is something we want to keep an eye on. On top is the S&P. Here's the home builders ETF. It's really been going down. In fact, we're really seeing this correlation dropping off. If we get a really low reading here, that could end up being negative for the market. So we'll just watch this one. And because we've only had 2 trading days in 2025, this goes back to the beginning of 2024. So you could look at it like the whole last year. We have gold doing well in stocks. That's the black line. The red line is oil. The green line is the dollar. The blue line negative are bonds based on price. Then looking at a very long-term oscillator for trend. Rolling over a bit here, but trying to get in an uptrend in China, rolling over with emerging markets, coming down in Europe, coming down in Japan, and now coming down in the US. We need to see if that can reverse and start to go back up. But we watch this because if this continues to go down longer term, especially for the S&P, that could be shifting the overall climate. And we look at correlations between stocks and the dollar coming back up but getting close to this neutral area, meaning they're having a slight tendency to go in opposite directions. The correlation between the S&P 500 and oil, also a slight tendency to go in opposite directions. The S&P to the 10-year yield, they're actually a slight tendency to go in the same direction right now. And a really strong correlation between the S&P and the 2-year yield. They're going in the same direction. One's going up, the other one's going up, and vice versa. Then the 10-year yield to the tech sector, slight tendency to go in the same direction. Then some long-term charts here. This is a monthly chart of the NYSE composite coming down, but still well above this. This is a 12 period, so it's for each month, a 12 period moving average here. And rolling over a little bit, showing some vulnerability with the longer-term Copic curve, which is another momentum oscillator. If this starts to roll over, if we drop below the moving average, that could turn things longer term more negative. This is a daily chart of the NYSE record high percent index. This has been going up, but it has been seeing some weakness. We look at the S&P. This is a monthly chart, still above its 12-month moving average here, but rolling over a bit with the PPO. This is a momentum oscillator. We're a little bit concerned about this. As we've been coming back down, this has been rolling over and actually turning a little bit negative. We'll want to keep an eye on that longer term. And then we look at the S&P on top and then do a ratio between the S&P and the CRB index. This is longer term than what I was showing before and displayed in a little different way. We're rolling over now because commodities have been going back up and stocks have been going down. But longer term, this ratio still shows that stocks are outperforming. Then we look at another global index and compare it with US stocks. And when this is going up, that means US stocks are outperforming. This is actually longer term positive. The KST, another long-term oscillator, is starting to go back up. Then at the end, I look at all those things that are positive, and our list is still very long. And what I define as positive is when the 50-day moving average is above the 200-day moving average. Both growth and value by themselves are in uptrends, and the dollar's in an uptrend. The CRB index, it was actually on the negative side a week ago. With the bounce up this past week, it's now turned back to positive. Gold and silver are in uptrends. The mega caps, the FANG index, ARC, the low volatility ETF by itself, but when you compare it to the S&P, it's been really underperforming. Staples are in an uptrend, the Dow Jones Composite Average, and then bonds based on price. All of the different bonds that we look at, except for emerging markets, those are on the negative side. The tech sector, high leverage loans, another barometer of the economy. The Dow, the NYSE Composite, and the Wilshire, they've been getting hit lately, but they're still in uptrends. The NASDAQ and NASDAQ 100, we're watching the 50-day moving averages on the daily charts for both of these indexes. Mid caps, small caps, and micro caps, even though they haven't really performed all that well, they're still in uptrends. All stocks, international and US stocks, emerging markets, and Bitcoin is still in an uptrend. Then on the negative side, this is when the 50-day simple moving average is below the 200-day simple moving average. Copper's in a downtrend on the daily chart. It's still in an uptrend on the weekly chart, but that takes longer to develop. And then the euro, the yen, and the British pound when compared to the dollar. And then depending on how you look at the SOX index, it's going down, where the SMH ETF is still in an uptrend and still holding its support. and the world bond index is in a downtrend. Thank you. I hope you found this helpful. Have a wonderful weekend, and I will talk to you in the next video.